Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and we're getting an update today from Erik Wetterling, also known as the Hedgeless Horseman. And we'll put a link to the Hedgeless Horseman website down below this so you can follow along with Erik's work. And Erik, we've been talking for a while off mic just about what we're seeing in the development stage companies. I think most of the ones we were looking at were gold-focused companies, but we were looking at economic studies, and we were looking at where the base case metals price is, debating what it should be, but then also looking at where things are valued at spot prices. And some companies don't even have an upside case that even comes anywhere close to spot because they're so far removed from where the metals prices have grown over the last year or so. So we're maybe just going to kick this off with some general comments, and then we'll dive into some of these individually. But I guess just as a takeaway, we're at 2,600 plus gold right now, and there are still companies using 1,600. There are majors using 1,400. And we're starting to see some companies using 1,800 or 1,900 metals assumption prices, but we're $700, $800, $900 above those. So unless people think gold's falling out of bed in the next year or so and going back to 1,600 or 1,500, should these companies be using larger base case numbers that reflect at least somewhere closer to where things are at? And should they be including at least a metal sensitivity table to show things where they're at today at spot prices?
Yeah, absolutely. I mean, the thing is, I think impulsively you see a base case as like, somewhat conservative, let's say. And then when you see something called, upside case or whatever, that sounds like, upside surprise or upside potential, like blue sky potential. And you've had these juniors for a while now. I mean, gold has ran up quite quickly recently, but you see base case scenarios of like $1,700 gold, and you have an upside case of $2,000 gold. And we haven't obviously seen the juniors really rip that much, especially the gold juniors compared to what gold is doing. I think it's just, the sector is doing itself a disservice basically, because a higher upside case, I mean, it sounds like there's something theoretical that is like intangible, that it could happen, yada yada, but base case is like, that's probably what we should stick to. But it's typically right now for a lot of juniors, I mean, there's a bigger difference between the higher case to the spot price than it is for the base case to the higher case. So it makes no sense really, in my opinion, to cut it off at 2,000 or 2,200, whatever. I mean, why not include spot gold? Because there's nothing speculative about that at all, except for, yes, gold could obviously go lower, but many of these units looks just ridiculously undervalued at $2,000 gold. So just use that as a base case. Again, I think it has some kind of signal value when you have the entire industry, which you described earlier and we talked about off mic, where it's like, the majors use 1,400 or 1,500 for reserves, and you still have juniors doing 1,700. I mean, that just signals to everyone, it's like nobody believes that the gold price will be here. So I think that's just, again, it's like we don't believe our eyes, I was going to say. And most of the junior presentations, or many, it's getting better perhaps, but it's like they implied that as well. Since their base case is like $1,000 lower than where gold is, and they have like speculative upside, I'm adding the speculative, of $2,000 gold. But that looks like a negative scenario if you compare to actual reality, which is gold at 2,600.
Well, and can you imagine any other industry saying, hey, here's where cars are priced, or where phones are priced, or where hotels are priced from 6 years ago? We're not going to show you where the prices are today. The whole way up in the sector, we heard people saying at $1,300 gold and at $1,600 gold, we have to deal in the real. We have to use the metals prices as they are today. We can't hope for higher metals prices. But now that we have higher metals prices, they don't want to use where metals prices are today. It seems like a conflict of logic. It seems like hypocrisy to me to say, let's use the metals prices where they are today for comparison purposes. Well, if that's the true, then every single development stage gold or silver company should be using $2,500 gold and $30 silver as far as a spot sensitivity on their table. So at least people can check it. They can use a lower base case. Okay, use 1,800, use 1,900, but at least show us where spot is today. And if you want to show upside, don't say it's 2,000, say it's $3,040 silver, if that's where people think it could go. And you made a great point, Erik, off mic, and said when the 2016 rally, you were seeing companies that had stretched so far, they were actually trading above where spot prices were and anticipating where things were going. We're so far below, I don't even know if we can get back to parity.
I mean, that is where it gets really interesting. I did a video a few weeks back, which was titled something like how a bull market in juniors could evolve. I mean, this is, I think we're stuck in the sentiment loop, kind of. Nobody's believing their eyes, and you can't even see, as we just talked about, what the actual value is for some of these projects out there at today's gold price, let alone tomorrow's gold price. And so I can see maybe something happening like, because we know nothing changes sentiment as price. So once we, for whatever reason, get an uptrend going in the junior sector, let's say gold goes to 2,700 or something, and these juniors really start to move. I mean, we can only imagine what the NPVs are for these juniors at $2,700 gold. And when it gets going, I mean, it's a pretty good position to be in if the gap from market cap to NPV at spot price, for example, at that time is like, oh, that's a 6-bag or 7-bag or whatever. Compare that again to, okay, you're in juniors in the top of 2016 and silver is at whatever it was, 30, it's pricing in 35. That's your upside scenario, that metal prices simply will go up. So what you just bought that's pricing in $35 silver will not look cheap, will not look expensive, because actually silver is going to 35 and hopefully higher at that point in time. I mean, imagine if we go from where we are right now in terms of dislocation, sentiment, undervaluation, getting an uptrend started, gold price going even higher. People are throwing around what the actual NPVs are at spot gold, which at that point might be $2,700. And then I think it's going to be like the analyst reports, for example. I mean, nobody dares to. I don't throw out target prices willy-nilly right now, for example, because nobody would believe it. I mean, if you post, yes, I post sometimes like, oh, hey, this project, for example, is on paper worth 2 billion right now. It's selling for 100 million or 200 million, whatever. It's like you're just throwing it out there because you know nobody's really going to care. I mean, you're kind of, quote, pumping with the literal truth. That's the NPV, according to a third-party expert, at today's gold price. I mean, that's a fortunate scenario to be in, where it's like anybody can pretty much, quote, pump by just, hey, look what this project is worth right now. I'm not saying they're going to find the next Voisey's Bay. I'm not saying gold is going to go to 5,000. This is the upside according to the economic studies at these prices. I mean, we've never seen anything like this.
Well, and I think it may be helpful to even provide a couple examples. So I just pulled up a couple quick ones that I met with in Beaver Creek, just as a case study here. So one of the companies I met with was Thesis Gold. They're traded on the TSXV under the ticker TAU. And they just on the 5th of September put out a economic study, a PEA for their Lawyers Ranch project. And in here, I think they did a good job. So I want to highlight them as a company that I think gave investors information on both sides of the spectrum. Their base case is $19.30 gold and $24 silver, which obviously we're way above those prices now, but that's a reasonable base case. Gold is $700 higher than that. Silver is about $7 higher than that. So it seems reasonable. They gave a downside case, $17.50 gold, $22 silver. Okay, if metals prices even fell even lower, here's what it looks like, the project. But they also provided $2,500 gold and $30 silver where we're at, so the spot area. And then they even provided an upside, $3,000 gold and $35 silver. And when you look at it, based on what you just said, Erik, their project at their base case is worth $1.2 billion. But at today's spot prices, it's worth $2.247 billion. So basically, it's almost say $2.3 billion because we're higher metals prices. And at $3,000 gold and $35 silver, that's a $3 billion project. So it's worth somewhere between $2.3 billion and $3 billion right now, and yet it's being valued at like $176 million market cap. So that's like 13 times just to get to their NAV at where it is priced today at $2.3 billion. And we're not talking about, oh, are they just a little undervalued? They're getting 0.4 versus 0.6 NAV. I mean, this thing's at like 0.07 NAV. So these are huge disconnects. And just another example is I met with Vista Gold in Beaver Creek, Colorado, and they shared with me that in their sensitivity table that at their base case on their feasibility study of $1,800 gold, their project's worth $1.1 billion. But at $2,500, which is today's spot price, it's worth $2.9 billion. So essentially, we're a little higher than that. This is a $3 billion project, and the company is trading with a market cap today of 117 million Canadian. So Think about the gap between hundreds of millions and billions. That's the re-rating potential.
Right. Exactly that. And of course, the producers, they are kind of enjoying this, of course, because, I mean, their cash flow is not seeing any sentiment discount. I mean, I recently listened to a junior producer, not anywhere close to the, world-class assets. And they're literally talking about, maybe we'll give out dividends in the future. I mean, when was the last time you heard that? So, I mean, for me, this just goes to show it's like, okay, I mean, how do you punish the market being this wrong? The producers are not extremely cheap, especially the senior ones. Why? Because when gold goes up, that shows up in their balance sheet immediately. Whereas, like, yes, there's a lot of juniors that might be 10 years from production. Maybe, I mean, most of them will never get to production. Exploration companies, I mean, they're not in production anytime soon, and who knows what the gold price is going to be at some point in the future. I'm looking at some juniors where it's like they're either in production and have a nice pipeline, or they could be in production quite soon. So I'm thinking like, well, if the Mr. Market is ignoring reality like this, where the gold actually is and what the value of the gold business actually is, I mean, if there are ways for the company to monetize on reality, I mean, if I can buy that kind of pessimism, I mean, that's great, because I'm playing around with, scenarios for some juniors, like, okay, let's say their growth curve actually materializes. I mean, how much, if gold prices in real terms stayed flat for the next 3 years, let's say, how much cash would they be throwing off? I mean, then you're sitting there, it's like, hey, I could be buying this at, 25% free cash flow yield or something right now. Of course, most are not in that position that they can kind of force the reality to matter, because most are early stage explorers and they need funding and all of that. But I do think it opens up this kind of subsector niche, let's say. It's like, okay, which are the ones that are closest to capturing the reality, which is the gold price, but are getting punished the most from sentiment, which is the, retail sentiment, let's say, totally ignoring the gold price. That's a space I'm looking at right now.
Yeah, it just boggles the mind. I mean, I agree with you on the producers. Even they are getting valued at levels that don't really match what they're actually pulling the metal out of the ground for. Right now, there's $1,000 margins for most gold producers. It's the biggest margins we've ever seen, but you wouldn't know it by looking at the GDX, which is a basket of all the gold producers. You wouldn't know it by looking at the royalty companies. Some of them have $1,500 to $2,000 margins right now. These things should be screaming higher, but I guess it seems that the market doesn't really believe these higher metals prices. And then back to the developers, that's really the next group of companies in the sector that needs to get re-rated higher, or else why would anybody want to explore for gold? Why would you want to poke holes in the ground and trying to find more of it if the best projects are getting valued at a 10th or a 100th of what they should be worth? I mean, I'll just show you one other example, just because we had some of these pulled up. Skeena Resources. A lot of people are familiar with this project. It's a great project in the Golden Triangle of British Columbia, traded under the ticker SKE. They at least have some different sensitivity tables in their presentation where they take you through, okay, here's $1,600 gold and $21 silver. Here's $1,800 gold and $23 silver, which I believe is their base case. And then they have the spot price sensitivity. Here's $2,500 gold and $30 silver. Their project goes from $2 billion to $3.4 billion at today's prices. So like if we're dealing in the real where prices are today, this is a $3.4 billion NPV. Now, people could debate whether we should be using NPV 5 or NPV 8, and we probably should be using NPV 8 as an industry. But for some reason, the whole sector is using a 5% discount rate. But even if you've used an 8% discount rate, this is a multi-billion-dollar project still trading for $1 billion. So, and at $3,000 gold and $36 silver, which doesn't seem that far away, it's a $4.4 billion project. So again, if in the past, investors were willing to bid up development stage companies because of where they thought the metals prices were going, why are we so far divorced in the developers, and why would you even want to be a gold explorer?
Yeah, I mean, the funny thing, like you pointed out, gold prices typically closer right now to $3,000 gold than it is to a lot of juniors' base case scenarios. I mean, that is just pretty remarkable. So I don't know what really or what's the reason for that. But I guess maybe, just maybe, we need to show, I don't know, have better examples of what this actually, what the implications are for this gold price. Because most people, I assume, that are, looking at juniors, they might not be owning Agnico Eagle or Barrick or Newmont, for example. So, you don't get that positive surprise in a lot of your portfolio. Maybe it's like myself, I'm only in juniors. So I don't see the impact of these much higher gold prices showing up in the cash flow of the juniors, because most don't have cash flow, and I don't see it showing up in the share price. And what the reason is for that, I don't know. The retail investors don't seem to be bothering with it, but I couldn't just say that's like, I bought the 2015-16 low. That was still speculation. I mean, almost no project was actually worth anything at $1,100 gold and $14 silver or whatever it was. So when I was buying that, I was contrarian in a sense, because I didn't get much of a steal when you use the real-time metal prices. Now it's just a walkover, basically. It's absolutely incredible. It's like gold needs to maybe drop $1,000 for some of these juniors to actually, that I overpaid for them. It's like we have this unique, I would say, generational perhaps thing where it's like you get this huge margin of safety, plus you have an at spot price huge upside at the same time. I mean, that's why I typically am not too keen on exploration stories nowadays, unless they are very, very good, because typically the idea of getting a 10-bagger meant you had to take a lot of risk. A future, meaning like exploration success, had to happen, and there was a small chance of that happening for you to possibly get a 10-bagger. Now it's like, as you just described, there's multi-baggers up to 10-baggers all over the place if you just look at their market caps versus their NPVs at spot gold price. So it's not like every single one will actually build a project and prove that was actually the value, but still, I mean, it's, if you have a somewhat diversified portfolio of higher quality projects, I mean, we're not seeing any real new mine builds going on, I was going to say. So it's like it's hard for at least the producing part of the gold sector to really clamp down on the gold price. Of course, there's an endless amount of gold above ground, but I just think it all speaks to the, inertia, or it's like total apathy in this sector. And I, for one, am liking these bargains.
Well, and I just want to make the case that I'm not suggesting, and I don't think you are either, Erik, that these companies should trade at their NPV at spot. I'm just saying, look at the delta between where they actually are valued and even their base case, much less where spot is, where in the past, people were actually bidding these companies up beyond where metals prices were with the expectations of where things were going, which has happened in other sectors. Look at Nvidia, that just became the market darling over the last 2 or 3 years in the big tech companies. It was trading way beyond its future earnings and way beyond its future cash flows because people were excited about where it was going. I don't think anybody's excited about where the precious metal sector is going. And my biggest fear and question to you is, if we get to $3,000 gold and $40 silver or $50 silver, is the mining sector going to miss it?
That's a good question. Again, I guess that is why I have somewhat focused as of late. I mean, the bigger the dislocation was, the more I started to focus on birds in the hand, meaning ounces in the ground, and also the ones that were fairly close to, or are fairly close to, actually putting something or being able to put something into production. Because in that case, the way I see it is like, I mean, if you buy something really cheap and it's not going to be in production for 15 years and it's not going to get acquired, for many intents and purposes, it is a trading sardine, because monetization does not show up to punish the market. So it's a greater fool trading vehicle, at least by how it trades. It goes up and down with sentiment. But it's like if you were in a junior, for example, let's say gold hits $3,000, and that's about the time they successfully get into production. I have a hard time seeing they trade for a P of 2, let's say, or 3 or whatever. So I think there are ways to kind of maybe position oneself to maybe take more advantage of that. There are many cheap producers out there, so I'm not going to rule out owning producers. But still, I think there are some cases that might be even cheaper, and they probably won't get stuck in that hell of like, well, sentiment is bad, so it doesn't matter if the project is worth on paper 10 times more, because if they're in production and enjoying very good margins, it's not going to be trading at 10% of MPVs, I don't think.
Well, just one more question on this as far as these valuations. And when you mix the producers and the developers together, a lot of producers are eventually going to have to replace the ounces they're mining and buy some of these developers. My concern, and I'd like to get your thoughts on it, is if we see takeovers now based on where the market caps of these companies are and they get a 30, 40, 50% premium, most investors will vote for it. But when you look at their economic studies, these producers are going to be picking up the developers at an absolute steal, nowhere close to where the project should actually be valued. So should the companies market to that? Should they maybe hold the ground a little bit and say, hey, that's not enough for this project. We just spent 10, 15 years de-risking it. You're not going to buy it for less than 10% or 5% or 2% of what it's actually worth at today's spot prices. You're going to have to make us a better offer. Should we start seeing M&A deals that are at 100% premiums, 200% premiums to make it more fair with where these projects are valued?
Well, the problem with that is that, yes, in a vacuum, that's completely true. I mean, I think some of these valuations out there is a complete joke. Even if you buy them at 100% higher price, you're still beyond stealing it at today's gold prices, for example, and probably at even lower gold prices. The problem is, of course, that, I mean, since I'm fully invested at all times, everything becomes relative. So it's like, I mean, if let's say everything is trading at 0.2 of NAV or whatever, should we be expecting that, you know, you got to pay 0.6% NAV in a takeout? I mean, that would be much fairer, but at the same time, I mean, for 0.6, I would be okay getting less than that, because, hey, with a 50 or 100% bump, if I have equally as cheap stories, then I could just take that premium and buy stuff that now is cheaper than the one with a premium. So it's like you're value shuffling. I guess that the worst case scenario would be basically all your best cases get stolen at 50% premium at this point in time. And when the actual move comes, there's no high quality stuff to actually park yourself in for the, you know, multi-year bull market. So I mean, I that is, I guess, a possibility. So it's hard. Again, yes, at face value, they should obviously get higher premiums, I think. But at the same time, since the opportunity cost and for the acquirer as well is, you know, okay, well, I'll pay less for a slightly worse project, or I'll, you know, these guys will be happy with 50-60% premium since everybody's gasping for air right now and, you know, cheer a 50% move. So in reality, I think that's maybe kind of hard to do unless it's an exceptional project, or the shareholders, let's see, a bunch of smart money controlling a stocks like, nope, we know it's worth 4 times this much or 3 times this much. We're not going to give it away for 50-60%. So those might be the cases where it's like you wouldn't see a deal like that. But I think, I mean, look around in the forums and on Twitter. I mean, people are complaining and whining about juniors, and it's like a mercy kill to a lot of people if you gave them a 50% premium. And it's like, here you go.
I hear what you're saying, but I guess I would push back and say I don't think all these projects are equal. I think a company that's de-risked their project for 10 to 15 years and shown that it's worth $2, $3, $4 billion. And there's a lot of them that we pulled up before this call that we don't have time to get into, but there's a lot that are worth a couple $1 billion, and they're trading for 100 million market cap or 200 million market cap, some of them. And if we compare those to drill plays that don't have anything yet, they don't have a resource, they don't have economic studies, and they're trading at 40, 50, 60 million market caps. There's drill plays that are trading almost at half or almost close to where the value are of companies that have actually spent a decade or two defining and de-risking a project that actually is economic and is worth quite a bit more. So if you got a 50% mercy kill premium and then you shift it over to another explorer that's still undervalued, I would say that those two projects are nowhere close to the same value.
Yeah, no, I tried to make that point. Maybe it came across bad, but that's very true. there are a few. I mean, for example, it's like my portfolios, like the ones I have, especially the more Derisked ones. I would not be happy to have my entire portfolio get bought out at a 50% premium at today, for example. In my mind, I'm thinking that my portfolio is worth at least 4 times what the portfolio value is right now. So that's my kind of base case assumption that, sooner or later the intrinsic value is going to show up. So it would be a really bad scenario if you have the, let's say, higher quality ones get bought out, and you would have to go down in, the risk reward scale, basically, started paying something for the birds in the bush and they don't have any birds in the hand. So then you're coming back to actually taking risk for a potential multi-bagger, let's say. So no, I agree with you on that front. And so again, it's like, I mean, I don't know if you should be sharing takeouts, at least at these levels, because like if our really good opportunity set keeps shrinking because the majors who know what the value of these projects are worth, and they know that shareholders would be okay walking away from it for a 50% premium. I mean, they're stealing all the value in that case. So I don't want to end up in a situation where it's like there's barely anything good around anymore because the majors stole everything because retail didn't bid up even the high quality ones.
Yeah, that's the same concern I have too, Erik. And we always hear that the markets are forward looking and that they're discounting things in the future. But I feel
That's a
like
good
right
one.
now, yeah, I feel like the precious metal sector isn't forward looking. I think it's backward looking. And I think a lot of the retail and even institutions and even some of the companies, the way that they are marketing and presenting and reacting to this is like looking in the rear view mirror instead of looking forward. It's one of the weirdest scenarios I've ever seen being in the sector 15 years. I guess final thoughts that you would give for people as far as the potential re-rating we could see, or are the markets never going to be forward looking in the sector, Erik? And are we never going to see these things re-rate?
Right. No, I think I mean, there's 100% certainty of a bull market in the future. There's no doubt about that. I mean, I think we've already started it. I just think it's a slow one, a stealthy one. When they will go vertical, I don't know, but I've been a part of a few rallies. Once they're up, I don't know, 100, 200% or whatever, once they show like a streak of gains, it's going to take on a life on its own. I mean, look at any junior. Look at any junior out there. There's like, when the recent past is down, you're going to see specific comments. If that goes up 20% the next week, or 30%, or goes up 10% in a day, all of a sudden people are going to show up and talk about it. So nothing changes sentiment like price, and I actually do believe that. So it's like, the way I see it, the rubber band is just getting more and more and more stretched. I cannot believe how cheap I can buy stuff like this. I mean, I expect to never ever see this kind of risk reward. If I keep investing in junior miners for the rest of my life, I don't think I will see anything quite like this. I don't think there is a higher opportunity cost right now than especially the gold juniors. Again, my base case is that there's 100% chance of a rally coming. I don't know how it will look. I don't know how much I'm going to make or lose on any particular stock, but for sure the next big move is up, and the sector has probably never had better reason to go up. We're just waiting for something basically to lit the fuse, have a few weeks of an uptrend, then everything can, all hell could break loose, because you're going to see how people talk about juniors is can completely change over a week, and then you might be seeing people put out slides of, hey, this is what this project is worth at today's gold price, let alone $3,000 gold price, and people are looking at whatever junior after it's run up 100% and seeing, whoa, there's a 5-bagger left. I mean, we've never typically been in that position where it's such a huge discrepancy between the business value at spot metals and the prices of these things in the retail driven market.
Yeah, some great points, Erik. And I guess we're going to have to be bewildered for a little while longer, but it just speaks to the opportunity that is still presenting people really hiding in plain sight in the sector. And if people like getting Erik's thoughts, definitely click on the link below this interview. It takes you over to the Hedgeless Horseman website, where you can follow along with some of the companies that Erik's taking a deep dive on, or some of the videos that he puts out where he looks at the valuations of some of these companies. So definitely click on the link to the Hedgeless Horseman to keep following Erik's work. And Erik, looking forward to our next conversation.
The same. Thanks, Shad. And if I talked about any companies, assume I'm biased. I might either own them or some might be a sponsor.